Hey, very good evening to everybody. Thank you for coming for my workshop. I'll be talking about how to retire early, where I will share with everybody a stress-free strategy to get out of the corporate rat race. And before I begin, the purpose of this workshop is to provide information on the subject matter of investing. So where I make illustrations with reference to investment securities, they're not a buy or sell recommendation on a company stock, an ETF, or bond or any other security, and myself and Dr. Well will not be liable for any losses or damage caused directly or indirectly by material contained in these notes. All right. So with that out of the way, my name is Christopher Nguai Chong. I have degrees in engineering, applied finance, and law. I spent 14 years in IT. I've authored 3 books on personal finance. And one of my books, Growing Your Tree of Prosperity, was a bestseller in the year 2005. And I've since appeared twice in the Me and My Money column. And the reason why most of you are listening to me is because I've gained financial independence at the age of 39. All right. And my goal for this evening is to explain in simple terms how to retire early. And for tonight, our agenda will be broken down into these components. All right. I'll be talking about early retirement. I'll describe our lives and our experiences in 4 phases. All right. Spring, summer, autumn, and winter. All right. Thereafter, we will take a short little break for about 5 minutes. All right. And then I will proceed to talk a little bit about the Early Retirement Masterclass, all right, which is the program that I have with Dr. Wealth. And at around, I think, 9:30-ish, all right, around 9:30-ish, no, sorry, at around 9 p.m., all right, we will have a Q&A. So if you have any questions that you want to ask me about investing and all that, you can put it in the chat group and I'll get back to you in a short while. All right. Okay, all right. So let's begin our discussion with a discussion about how our lives are, as Singapore citizens. Okay, and it can be briefly broken down into 4 parts. All right, the season of spring, the season of summer, the season of autumn, and the season of winter. All right, and our first discussion is going to revolve around spring, where we spend most of this time schooling and then starting out in our career. Okay. So for me, my early influences come from the retail sector. And my dad launched probably one of the most ubiquitous pet shop franchises in Singapore. You see them everywhere. All right. And I grew up in Shaw Centre, which is where the first branch was located. And it was at that point of time where I had a lot of experience as a little kid in a pet shop. And I understand the difficulties of being a retailer. If you can make enough money to make the rent, that's good. If you cannot make enough money to make the rent, then sometimes my parents would fight, right? And so I grew up with this idea that it's always better to be in a position of something like a landlord, rather than as a tenant or someone who pays the rent, all right? So that has sort of shaped my life and my influences, all right? And of course, as I started work, I faced my second financial challenge, okay? And that was where I learned that, we can't really trust commission financial advisors, all right? And it is at that time when I was about to enter national service, where my mom got for me an insurance program, and she was promised that all she had to do was pay until the point where I started work, and then the premium payments would stop. All right. But after I started work, the premium payments carried on for a certain number of years. And then I got impatient. I brought my mom to actually complain to the insurance company. And I found out that actually the insurance company could not meet the promise that was made to us. And they offered us 2 options, right? The first option is to cease paying for the insurance completely and let it lapse. The second was to continue paying for an unknown period of time. So for me and my family, we don't really want to be stuck, with this insurance policy. So we sort of allowed it to lapse over time, right? Yeah, and so the entire experience left a very bad taste in my mouth because I felt that the insurance company was aware that they couldn't meet what they was promised to the customer, and so it was sort of missold, right? But we didn't get a sense of satisfaction because my mom has been paying premiums for many years, okay, and compensation was not offered to us at that time. In fact, the offer is for whatever amounts that we have to lapse eventually, right? That means run out of insurance over time, right? So that left a very bad taste in my mouth. So as a consequence of that, when I reached the age where I started working, I began to unfriend anyone who invites me, to meet up with me in McDonald's and who tries to sell insurance to me. Okay, so maybe that's why I was able to build a larger portfolio of assets because for most of my professional life, I didn't spend a lot of money paying expensive insurance premiums. All right. Now, coming back to the subject of Spring, right? One of the problems that we experience in Spring is that, personal finance is not taught very well in school, right? For most of the folks in my generation, you're taught to be an obedient employee, and things like compound interest, the consequences of it, it's not really explained to students, right? And no one understands how crippling it is to pay sales expenses for investment products. And people don't have that kind of life skill to actually dig into like investment expenses or question a financial advisor, what is the total amount of management expenses that I would have to pay every year if I were to buy a product, right? So I think that's one of the problems in Singapore right now, where you've got this massive middle class and they're paying a lot of insurance premiums. And the truth is that we don't really, while they're getting protection, we don't really know whether how much commissions they're actually paying, right, to the companies as well as to the people who sell these products to them, right? And of course, in Spring, a lot of people ask the question, right? If studying hard is no longer a guarantee of good employment, then the question is, what kind of X factor can distinguish you from other people, right? So that's the kind of question that you might want to ask. Okay, and the missing X factor, according to some people, is that it could be found by reading popular books on personal finance, all right, to make up for the lack of proper financial planning expertise, right? We turn to books like Robert Kiyosaki's Rich Dad Poor Dad to gain a little bit of perspective on what we can do about our personal finances. And one of the problems with Rich Dad Poor Dad is that it's highly motivational. It makes you really hyped up about wanting to do something about your own personal finances. But the weakness in that approach is that he doesn't really give you any specifics on what to buy, right? And it's only after reading about 3 to 4 books where I discovered that Robert Kiyosaki actually is a creature of MLM, right? He authored a book called The Business of the 21st Century. And what that book does is that it tries to convince its readers not to turn away from these MLM programs. Okay, and it was after reading that book that I decided that, I should stop reading Robert Kiyosaki's books altogether, right? Because actually it's quite self-serving, right? It's quite self-serving to align yourself with MLM people. And a large number of people in my generation, I'm reaching 50 this year. You find that a lot of them, they struggle, right? Because of MLM, they've done MLM when they're much younger, right? Of course, one of the myths that we talk about in Spring is that studying finance makes you a good investor, right? But the truth is that actually, if you study finance very formally in a diploma or a degree program, you find that actually it's not really easy to make use of some of the models that you learn in school, right? Take, for example, the discounted cash flow model that we use to basically value an asset, right? The first thing that you need to do to use the DCF formula is that you need to be able to project cash flow into the future, all right? So that's the first major challenge that you have, right? And then what you have to do is that you have to then discount these cash flows into the present by applying a discount rate, okay? Yeah. Now, the difficult part is, first you need a crystal ball into the future to look at what kind of cash flow you're going to have. Like if you're the CEO of SIA, you might have to predict that there will be a pandemic coming in the year 2020, right? On top of it, as you discount these cash flows to the present, what kind of discount rate to use is subjective, right? You could be using the inflation rate, Singapore savings bonds rate. Some people might argue that the CPF 2.5% is a better discount rate, right? And without standardization, it's not easy to use these formulas as well, right? It become very, very subjective. That is why when you have different brokerage houses giving you, the target price for stock, you find that different brokerage houses have a different opinion as to what the value of the stock is, right? Yeah, so the tip in Spring is that you need to use the right books to pick up finance the right way. And for the folks who are listening in, I try to add as much value to you as you can, right, by creating free material in the form of my previews. And one very good book to start at is The Richest Man in Babylon by George Clason. The book, I think, is close to 100 years old or over 100 years old. You can finish reading it in 45 minutes. That will give you a very basic foundation in personal finance, all right? For the folks who want a little bit more, then you can read The Conceptual Foundations of Investing by the Cornells, and this book will give you all the basic lingo to become competent in investing, right? So that sort of summarizes what we've covered in Spring, all right? And the thing that you need to know about Spring is that it's all about financial education, the lack of it as you're getting younger. And what it does is that if you do not have financial education, then what will happen is that your childhood influences will determine your relationship with money, right? Yeah, and that would be interesting as we move on to the next phase where we talk about summer, right? Summer is the second quarter of your life, and you spend on most of this time making money. You also starting a family at this stage, all right? And for me, in summer, I worked largely in IT outsourcing. I was an IT professional, and then suddenly I had to go through the dot-com bubble, right, immediately after graduation. Okay, and then the outsourcing wave started to come in, right, where a lot of these IT companies started moving their operations overseas, right? And I was pretty determined not to let them dig my grave, right? And in doing so, I decided to dig other people's graves by becoming an IT outsourcing kind of professional, where I would document, for example, processes in Singapore, fly over to KL to train a team to take over the documented processes in Singapore, and then I would then fly over to Bangalore and I'll do the same to the call center in KL, right? And with that, I did quite well professionally, right? Until one day when I received an email and I received a message that one of my colleagues, a contractor, his contract was not renewed because his work was outsourced to Eastern Europe by a different team. And he locked himself inside a room, switched on a barbecue device, and he likely died of carbon monoxide poisoning, all right? So a colleague committed suicide. So when I received the news, I was very distraught, right? I finally realized that when you do outsourcing and you work out of the country, you're endangering lives, right? And the thing you do can be quite bad, right? So I set off a journey for myself to, first of all, find a solution to the problems of cash flow, right? Obviously, you can't rely on one job, right? And even 20 years ago, corporate loyalty was a thing of the past, right? So I studied the CFA program to see whether I could come up with some sort of a solution or cure to my financial ills. And then later on, I intended to author a number of books to be able to help other people solve that problem, all right, in Singapore. And so I embarked on a journey of self-study of the CFA program, right? Chartered Financial Analyst program, where I picked up a little bit about finance. And it was then when I started understanding what I've explained to you earlier on, that financial models are very unpredictable, very difficult to use, right? Until I found a paper that changed my life. So this is a research paper in the year 2003, more than 20 years ago. It is published by Robert Arnott and Clifford Asness. Clifford Asness is the billionaire founder of AQR Capital Management, all right? And the topic is surprise, higher dividends equals higher earnings growth, all right? So the historical evidence strongly suggests that expected future earnings growth is the fastest when current payout ratios are high and slowest when current payout ratios are low, all right? Now, what does it mean? It means that if you have a company, and what this company does is that it gives out money back to the shareholder, right? Normally, this company is run by very down-to-earth managers, right? They are very disciplined with money. They don't do things like embellish their office with Renaissance artwork. They don't install golden taps in their toilets. So because of this, these companies have a tendency to grow. And funny thing is that they actually grow faster than managers who retain the cash because the managers actually misuse the cash hoard that they have. They also commit to empire building, right? Yeah, and so after I learned this from this paper, I decided that, maybe it is time for me to sort of change my life and do something about my finances, right? So after this, I began to liquidate the unit trust that I bought, right? Remember that in my era, in the year 2000, 2001, there are no exchange traded funds, and most of my money was tied in unit trust because I didn't have a lot of money and I wanted global diversification, right? And that was when I started to transfer my funds into dividend stocks, right? Like SPH, right? SPH doesn't exist anymore. It's not even a good dividend stock these days, right? Just before it got taken out. In those days, stocks like SPH gave a 6% dividend, and it was able to pay like 4 days before my birthday. All right. And I think that's the life-changing moment for me. Okay. And the life-changing moment was I can look at my life in the form of a very simple game I can play with myself. All right. So you can imagine yourself as having some kind of a horizontal line that represents your basic expenses. Okay. And then as we build a portfolio of dividend stocks, you have investment income coming in slowly, but eventually, it would accelerate exponentially, right? Because you're saving more money and you're getting more dividends to save later on, right? And so when your dividend income exceeds your basic expenses, you reach a crossover point, all right? And that's when you become financially independent, okay? So for me, because I was able to gradually lower my expenses as a bachelor and I lived with my parents at the time, I was able to reach crossover point at the age of 32, right? Obviously, subsequently, as I got married and all that, I lose my financial independence, but I quickly gained it back because I had two incomes coming into the house, and as your family grows, you will occasionally lose financial independence, but you regain it back if you are a disciplined saver, all right? Yeah, but generally that is the story of how, right, I was able to attain financial independence within a very short period of time, right? Because I discovered the power of dividends investing quite early before the FIRE movement became a popular thing, right? And so I realized that a lot of people are unhappy at work, right? During the pandemic, there was the Great Resignation in the US. There was the Lie Flat movement in China. And I think a lot of people want to discover whether are there ways to actually achieve a more relaxed lifestyle instead of just slaving for someone else's ambitions, right? The Chinese have this thing 996, right? Work from 9 to 9, 6 days every week. Okay, no wonder they're burnt out, right? Yeah. And financial institutions in summer, they're also aware that you're at your wealthiest point in your life, right? And so there might be they've trained a very motivated pool of friends, who will call you up, invite you to McDonald's, so that they can make some commissions from selling you ILPs. All right. So financial institutions like to do that. All right. And of course, in summer, you also have to deal with issues like your skills depreciation, right? The half-life of knowledge is now very short, okay? And people can become experts very quickly using tools like ChatGPT, right? As a consequence of that, you find that the degrees that you spend many years of earning, right? These degrees might not, the value of the knowledge depreciates rapidly, okay? And while that is happening, the mortgages you're getting into still last 20 to 30 years, all right? So you do not have much time to earn your keep in a modern economy. You keep having to go back to reskill, and then reinvent yourself, right? It's very chaotic, okay? And I think that is the essence of summer, right? You earn the most money at this peak of your life, and if you spend too much time indulging in your lives, you will pay the price later on, right? And so the summer myth is retirement is impossible unless you listen to a financial advisor, right? I think that is the essence of a lot of when you attend a lot of these financial festivals, like kind of events, right? A lot of these people from financial institutions, first of all, they are very threatened by the concept of the FIRE movement, okay? And secondly, they still want to convince you to buy some of their products, right? Claiming that you won't be able to do it on your own, okay? Now, to deal with that myth, right, I need to walk you guys through some model assumptions on retirement. All right. So over the next few slides, I'll explain to you what retirement actually means. Okay. And the first point is you need about $500,000 to retire. And how do I derive that? Okay. The Lee Kuan Yew School of Public Policy in 2021 said that a single person at the age of 55 needs about $1,768 a month, right, to lead a dignified kind of existence, right? Okay. So if you take 1,768 and you multiply that by 12 and you divide it by 0.04, and this 0.04, okay, comes from the concept of safe rate of withdrawal. You have $1 million, right? If you have $1 million, then you can spend about $40,000 every year and adjust it by inflation, your money will last about 35 years. So that's where the 4% comes from. It's an industrial standard. So if you take 1,768 times 12 divided by 0.04, you get about $530,000, right? So that's where my $500,000 comes from. Next, you only have 10 years to have proper retirement planning, right? For a person that's completed national service, right, and completed a 4-year degree, you'll be age 25. You spend the next 5 years exploring, right? The next 5 years, you might be, for example, jumping around, job hopping to find a good working environment. You might also be getting an advanced degree, okay? So a lot of people, because it takes a longer time to settle down and become an adult, right? You find that the only time where you can start saving money and take your finances more seriously would be around the age of 30, all right? So that's the norm these days. But if you look at the folks who are getting retrenched, the folks younger than me by a decade, right? Folks in their 40s are getting retrenched, right? So if you were to arrange everything in a timeline, you will find that the best time to actually do retirement planning is the 10 years from age 30 to age 40, right? And if you can do your retirement planning successfully by this time, then you can avoid the chaos that comes with being in your 40s and getting retrenched. Because when you get retrenched, the government will make you reskill, okay? And then after that, you get re-employed, all right? Retrench, reskill, re-employ, all right? That's the 3 R's, okay? And so that's something that you may want to avoid. And the third assumption is you can save $2,000 a month, right? This $2,000 a month, right? Basically, I took the number from our median incomes, okay? But my numbers are a little bit dated. They're the 2020 numbers. So if you imagine that you advance by 4 years, right? So there is some inflation, wage growth being tied to it. And then you take away your CPF, right? $2,000 is about 50% of your take-home pay, right? 50% of your take-home pay, okay? And so that's basically someone who has a very strong willpower, who wants to do retirement planning, and he wants to complete it within a decade, all right? And to do it within a decade, he needs to raise $500,000 for himself. All right. So that's basically what I'm trying to say. Now, can existing financial products allow you to meet that goal? All right. So that's the next question that we want to ask. So we can look at some insurance products first. And now imagine an endowment fund that pays 2%. Okay. So we can use a compound interest calculator to find out how many years it would take for us to raise $500,000. All right, we obviously start with 0, okay, and we add $2,000 every month. All right, and what we do is that we increase the number of years slowly until the future value hits $500,000. And if you do this, it will take you 18 years to reach your target. All right, so we do know that if we are to confine ourselves to short duration, short-term endowment funds, we won't be able to meet our retirement deadline because 18 years is far too long compared to 10 years, right? So short-term endowments, this is the result, right? We can do the same exercise with long-term endowments and anything that they claim based on their benefits illustration that will give about 4%. And if you do that, then we're talking about 15 years to meet the target, right? Now, some of these agents, the nasty ones, would then pull out the investment-linked policy. They will try to sell an investment-linked policy to you. And investment-linked policies, they're very complicated instruments, right? You have to allocate some money to the insurance component to the investment component, and it comes with very expensive administration fees, right? And their management fees as well. So because of this, it is very difficult to project the kind of returns an investment-linked policy can provide for you. So what I've done is that I assumed a basic global equity fund that gives 9% every year. But once you deduct your costs, right, you deduct 4%, you end up with 5% every year. Okay? And we go through that process, we can estimate that it will take about 14 years for you to reach your retirement goal. Right? So actually, whatever the insurance agent can sell for you, highly likely that it will not allow you to be able to meet your objectives. Right? So what about banking products? Banking products are mainly unit trusts that they sell to you, and you have to pay a rep fee. And because of all these miscellaneous expenses and trailer fees, maybe you get 10% from a global equity fund, but you have to deduct 3.5%, from your administrative charges, and if you do this, it might take 13 years for you to hit your target, right? So therein lies the problem. Okay, Singaporeans pay too much for unit trust. This is actually explained in the Business Times. Okay, and the main reason is due to this thing known as a trailer fee. Okay, so what am I driving at, right? For this section in summer, what I'm trying to say is that if you do not take your financial destiny into your own hands, you will fail, right? Because mathematically, the products are expensive. Somebody is leeching off your investment returns, and you will not meet your retirement targets, right? And at the core of this problem is a conflict of interest, right? You want to save your money and you want to retire early. Somebody else wants to earn the money from you, right? So I think that's the fundamental problem, okay? Now, in such a case, then how do you retire early then, right? How do you retire early? How do you actually succeed in early retirement? All right. All right. Now, before I get to the part on DIY investing, I'd like to just give a very short lesson on what's the fundamental problem with financial advice, especially when some kind of a rookie advisor were to ask you out for a meal at McDonald's, right? This is what you really need to worry about. And the thing that you need to worry about is this thing called thematic investing. What thematic investing does is that they will try to introduce a product to you that has a very strong recent performance. That means maybe it is an AI fund, maybe it is some kind of geographical fund like Indian equities, for example, right? And you're attracted by the high returns, you buy it, without understanding that actually when you get these thematic investments, you are subjecting yourself to a market risk that is maybe 10 to 20% higher than many other retail investors. Okay? Now, when the returns, right, eventually return to normal, you might find out that you might actually have higher losses, and it can also affect your retirement outcome, right? So essentially what I'm trying to say is this, right? We shouldn't look at just returns when we look at an investment. We also have to look at the risk. And the risk is measured by this thing known as a standard deviation. Okay? So when you have an investment that is very stable, right? Very stable, like, the returns will be very close to the center, right? But if you have a very risky kind of return, right, you'll be all over the place, you won't be able to sleep well, and it actually reduces your probability of retiring early, okay? And that I can only demonstrate to you, okay, by sharing with you a computer program I wrote using a programming language called Python, all right? So let me just reconnect and I'll run this computer program, okay? Yeah, so one of the things about learning about investing is that you have a very big advantage if your instructor knows a little bit of coding. Because what he can do is that we can demonstrate with data why something is the case, right? Instead of just, telling you a lot of investment stories and then impressing you with high returns, right? That doesn't cut it, at least in my book. So what I have here is a simulation of 500 retirement portfolios at a particular return and a particular amount of risk. All right. And there's a failure rate of about 10%. Okay, so that's the default. So let's see what happens when we increase the underlying returns, right? If the underlying returns were to increase, then naturally the failure rate drops, right? Because you get higher returns, people tend to succeed in retirement. Okay? So that's very easy to understand. But what people don't understand is this. If you increase the underlying risk, keeping the returns the same, that means the underlying risk goes up, but the return remains exactly the same. Your failure rate can increase dramatically, right? 20% in this case, right? While the mean return in both cases is 1.34%, right? So that's what I'm trying to say, right? When we are looking for an investment, remember that choosing a portfolio with relatively low risk matters to a lot of people as well. All right. So I'm going to talk a little bit about DIY investing and how to make it work for local investors. I will illustrate using the Singapore stock market that hasn't done very well of late. Okay, but the reason why I like Singapore is that it's very cheap. The price to earnings ratio is very low. There are no capital gains or dividend taxes, and there are no problems with estate planning if anything were to happen to you. All right. So when you combine all these three things, right, it's actually a very attractive place to park your money right now. All right, because it's been beaten down so badly. All right. So one of the things that you can buy as an investment rookie is the Straits Times Index Exchange Traded Fund, or the STI ETF, right? The STI ETF, when you buy this one counter, right, it will give you access to 7 real estate investment trusts, 3 banks. And so what you do is you get this the best Temasek-like companies, right? So you've got your DBSs, your UOB, your OCBC, it's got Capital Land, it's got SGX, it's got Singtel, it's got Venture Manufacturing. All right. So these are the largest companies in the Singapore stock market, right? So for a lot of investors, they just buy this ETF and then they observe to see what happens, right? Now, if you've been doing this for the past 16 years, right, from January 2008 to the year 2024, early this year, your return is just 0.6%, all right? So this kind of rookie strategies don't make it. And if you do this, you will need 20 years in order for you to get out of the rat race. At $2,000 a month, you will accumulate $500,000 in about 2 decades, right? Yeah, and the risk is sort of, okay, it's considered rather low, but still the returns are not impressive. Okay. Now, the fundamental problem with the STI ETF is that it is capitalization weighted. That means most of the amounts of money that you have is allocated into the banks. Okay, and 45% of it actually is placed into DBS, OCBC, and UOB. So if interest rates have been low for the past 20 years, then naturally banks will underperform and the Singapore stock market will then underperform, right? Yeah, so how do you sort that problem out, right? You can improve your performance, okay, by going to the Business Times a weekday. You get a copy that shows you all the Straits Times Index components and you buy them in equal weights. So there are 30 counters in the STI, you have $300,000, you put $10,000 into each counter, buy them in equal weights, all right? So if you're able to do this, right, then you're able to improve your performance slightly, all right? And your performance goes up to 4.5%, the volatility is 10.2. So actually, you can get a higher return, but you do it at a lower risk, all right? So your risk actually reduces slightly, okay? And the number of years you need in order to reach your target is about 15 years for you to reach your retirement target, all right? Not too bad, okay, but not too great either, okay? But at least it's a little bit of an improvement. So the question that you want to ask yourself next is, maybe I don't want to buy all 30 counters. Okay, I want to buy a lower number of counters, like maybe I buy 15 counters, but I set a criteria on what to buy, right? And this is called factor investing. For example, I can pick 15 counters with a higher dividend yield or lower price to earnings ratio. Well, it all depends, right? So suppose I pick, right, stocks with the highest dividend. So I go to the Business Times, I get this table, I find a column that says dividend yield, and I pick 15 of them, right? I use a pencil and I pick 15 of them, okay, and then I invest in it. And then next year, I sell my stocks, I buy the next 15 highest dividend yield. So I rebalance every year, all right? I rebalance every year, okay, and let's see what happens when I do that. Okay, if I do this, my performance goes up to 5.4%. The risk is a little bit higher because I'm buying a lower number of stocks, right? So that's how I do it, right? I now have an idea that dividend stocks might provide better performance, okay, but 15 dividend stocks will only give me 5%. How do I improve it, right? I have to add criteria. And there are computer programs out there that can increase the number of criteria that you have in order to invest, right? So in this example, I have complemented a dividend strategy with high net profit margin and low price to book ratio, right? In fact, I can create a lot of criteria, right? 8 STI stocks with the highest dividend yield, lowest price to earnings ratio, lowest price to book ratio, and highest profit margins. Computers let you do that, and I shortlist 8 of them. All right, these 8 stocks, right? I can get 10.2%, 10.2% with downside risk of 13.5%. Okay, and that is not too bad, right? Once you get into the double-digit range, okay, your performance begins to improve. And now you reduce your retirement plan to just 11.1%, right? 11.1%, you will hit $500,000, right? Buying about $2,000 worth of stocks every month, right? Now, with a double-digit improvement and applying 4 different factors, right? Dividend yield, price to earnings ratio, price to book ratio, and high profit margins, you come to a situation where as you improve the model further, your improvement in returns is no longer, you reach this diminishing return, okay? Diminishing return, right? So how do you push your annual return further, right? If you want higher returns than that, then you have to take a little bit of risk with your portfolio, right? You notice that the kind of stocks that we pick, right, with Singapore blue chips, they tend to be very, very conservative counters, all right? What if we can borrow money from a broker using a margin account and we invest it in the markets? For every dollar that we have, we borrow $1 and we leverage it by 2, right? So if you have $100,000, I buy $200,000 worth of blue chips, okay? And of course, when I do this, the money has to be borrowed from the broker. They'll charge an interest rate. The lowest interest rate is still quite high right now, about 4.8%, all right? 4.8%, okay? So right now, leverage is not a very good idea. We have to wait, right, for interest rates to drop before it becomes feasible, okay? But even at a borrowing cost of 5%, right, and you've got a double-digit return of 10.2%, you will still get 15.5%, right? You get 15.5%, right? And this actually, if you put it into your compound interest calculator, the risk will obviously be very high. And so the risk needs to be managed, right? And the risk needs to be managed, all right? And you need to learn how to do that, okay? But the number of years you take, right, would be around 10 years. So with 10 years of effort, and if you're willing to take on a little bit more risk with a leveraged portfolio, you will be able to hit about $500,000 within a decade. Okay, right. So remember that the table on the right will show you typically the kind of blue chips that end up in such a portfolio. They are very, very conservative blue chips. Okay, and this is basically what I'm trying to say in summer, right? Now, early retirement is possible if you're willing to level up your investment knowledge, right? You start with a very unsophisticated ETF technology, you get 0.6%. Then once you understand the weakness, you buy the stocks individually, your performance improves to 4.5%. If you shortlist stocks with high dividend yields, your performance improves further to 5.4%. Okay, and then you begin to think about sophisticated investment models, and that can get you into the double-digit range. Okay, and once you get to the double-digit range, you might not be able to improve returns any further because the rest of the stock market hasn't done well for the past 16 years, right? But you can use leverage. That means you borrow money in order to invest in the stock market to get about 15.4% returns, right? The investment has to be in your brain, right? Invest in yourself to get some investment knowledge so that you can come up with better returns over time, right? Okay, so we're done with that section on summer. I think the most important thing about summer is the importance of financial education once again. Okay, but more importantly, summer is a time where you get a lot of distractions. People claiming to you that they have products that will be able to help you attain financial independence. Other people will tell you not to try to pursue financial independence, right? All of them may have some selfish motives out there, right? Okay, now let's look at autumn, right? Autumn is the third quarter of your life, and this is where your life begins to slow down and your happiness reaches an all-time low. So for me, I began to make some career mistakes when I made the transition from the private sector to the public sector when my daughter was born. I wanted more work-life balance. But in the process, I ended up working for these very, very old-fashioned, toxic, and elitist kind of companies, statutory boards, where there is very little respect, right, for the rank and file, right? So in one particular engagement I had with a senior manager, we were talking about some technical aspect of programming. I was explaining to him that one programming language called Ruby on Rails, you could actually create a functioning website, right, with a database, business logic, and a front end, right, with one line of code, one line in the command prompt, okay? And he didn't agree with what I say, and he's not technical, but he pretends to be technical, so he picks a fight with me. And I had to stand my ground, right? Because we're dealing with the truth. I cannot allow someone to bend the truth, right? Because I'm an engineer, I talk the truth. So I began to clash with him. And this guy is a senior manager, right? Senior director. He's many ranks higher than me. But the truth is on my side, right? So I fought and I argued until he decided not to argue with me anymore. He invited a young Ivy League scholar to deal with me. He said, "Who's right, Chris or me?" Right? So he threw it on the table in front of the young scholar. And you need to understand, the young scholar his rating depends on this senior director, right? And the senior director basically could determine his career fate. Okay. Yeah. So I thought the scholar would throw me under the bus. All right. But the scholar said, actually, with all due respect, Chris is right. I can program in the programming language. Ruby on Rails can indeed do this. Okay. So I won the argument. Okay. Now here's a funny thing, right? You would expect the senior director to argue with the scholar, but that didn't happen, right? The scholar is his blue-eyed boy, and the organization favors these scholars. So I was actually allowed to do whatever I wanted to do, right? Yeah, but I was extremely angry because this is a very elitist environment, and my working experience will not get me any measure of respect, all right? We're just waiting for the next debate to come, and I have to debate my ideas extremely rigorously. Okay, yeah. And of course, it didn't take very long, right, for me to figure out that I really need to get out of this organization, right? A couple of weeks later, the organization has this culture of chewing up employees. You basically put them in these glass panels, and then after that, the boss will shout at you, right, very loudly so that the whole office can hear you being scolded. So I was brought into a glass panel, and then I got shouted at by my insane lady supervisor, and I couldn't figure out what went wrong. Okay, and I thought I was doing well, right? The customer was happy, and the projects are moving fine. Eventually, I found out what was wrong. I was being accused of starting a project without going through the formalities, right? Which is then the question is, what are the formalities? You need to give me the formalities before I can follow them, right? So I asked for documentation to help me. I told her that I will expedite the form so that we don't lose the momentum on this project, right? Yeah, but unlike an adult, my supervisor just continued shouting at me at the top of her voice, right? To which I then said, you're not willing to help me solve the problem, right? I'm doing my best. Even if I made a mistake, I'm happy to rectify it. And we actually don't have any angry customers complaining about us, right? So what's your problem, right? Yeah. But because she's not willing to work through the problem like an adult, I told her, I basically told her, fuck this shit, I resigned, right? Yeah. And I think that was basically it, right? Yeah, I felt that it was about time for me given that I made such a bad career mistake to fire my boss, right? And how did this happen? Okay, um, this is my family expenses, right? I have a family, then I have a child, okay, and what my dividend income was able to achieve is that it's not just higher than my family expenses. I've been financially independent for 7 years. All right. It's even higher than my take-home pay from the organization. So I know that my dividends can sustain my family without me working, right? Which is why I was able to fire my boss, right? Financial independence, retire early, fire my boss. All right. Okay. Yeah. And so that was the end. That was probably 10 years ago. And that was the last time I drew a monthly paycheck with CPF. All right. Now I managed to regain that recently. Okay. Yeah, because I've also decided to do some freelancing in a financial in an educational institution. Okay. Yeah. So what happened after I left at the age of 39 was that I had the rest of my life ahead of me, and I wasn't really willing to just immediately run back to the workforce. All right. I did something highly unconventional for most IT professionals. I left the rat race to study law. I went back to SMU. I went to study my Juris Doctor. My classmates are half my age. I was admitted to the bar in 2018, right? And actually, the funny thing is that I thought I would end up becoming a lawyer. But here's the thing. Yeah, the problem with Autumn is that a lot of your attempts to reinvent yourself will fail, right? So I ended up in a smaller law firm because of ageism. I couldn't do the corporate law work that I like to do. I ended up doing a lot of divorces and criminal law work, which I didn't enjoy. So when Dr. Well came to me and asked me to design the early retirement masterclass, I gladly jumped ahead, even though at that time I wasn't sure whether I was able to create a product that would sell. And as of today, I've graduated over 700 students and I've conducted 33 batches of training, right? Okay, now what is particularly important was what I actually did during law school, right? We had Bloomberg terminals. So I didn't spend all that time studying law. I was playing with my Bloomberg terminal to figure out which investments work and which investments don't. I was able to come up with a relatively strong portfolio. But more importantly, I was able to apply leverage, right? I borrowed more money from the broker to increase the dividends that I bring back. Okay, and why is that important? Because I'm a middle-aged man, right? I'm trying to reinvent myself. My wife doesn't work, okay? There is no income coming into the family, okay? And more importantly, I have a mortgage to pay. I have an EC. Mortgages are coming online, right? And so what would happen is that if I were to just use my dividends to pay my monthly expenses, it will be just enough, which means $200 to $300 for myself, right? So I can't do that. I had to leverage so that I could get like some leeway, $1,000 to $2,000 extra dollars every month, so that I could basically go through law school. And that's the beauty of it, right? When you have a very good financial model and you apply a little bit of leverage, you basically solve the problem of retrading, right? Because a lot of us, when we go back to school, maybe either skills futures or when you're studying for an MBA, the idea is that you have some savings and you will draw down on your savings. And when you complete your assignment, you get your degree, you get your diploma, you go back to work. But your net worth is actually much lower at the end of your education, right? So because I was able to have a portfolio and apply leverage, right, I was able to sleep well at night. And I ended law school having a net worth higher than the day I entered law school. And that's the most important thing, right? Because if my net worth is higher, I'm not under undue pressure to become a legal associate at a small firm, right? In fact, that was exactly what I did. On the day my practice training ended, I took my stationery and I ran. Okay, I ran. Okay, but by then my course materials were almost done. All right, so I knew exactly what I wanted to do at the end of the program. Right? Yeah, and so that sort of summarizes my very dark autumn. And autumn is really not the time where you can really fool around because for a lot of people my age right now, they're getting retrenched. Okay, there are people in their 50s getting retrenched. And they're used to a salary that is maybe 50% higher than my highest drawn a decade ago. And what these people are experiencing is that because the salary has been so high, they don't have a lot of savings and they don't have a job waiting for them. And the interviews are not going well. I have friends who have been interviewing for almost a year, okay, but they're still not getting a job because their expectations are too high. On top of it, we have to deal with higher living expenses. Our inflation numbers are actually quite high right now. GST has gone up this year, right? Commodities are not having a good time because of two hot wars going on, one in Gaza and one in the Ukraine, right? Jobs matching is hard, right? Looking for a job in your mid 40s is extremely difficult. Even if you find a new one, what if it's a toxic environment, right? So if you're in your 20s and you're very used to very plump multinational jobs like me, okay, you're going to have a very hard time in your 40s, right? There's also ageism and jobs discrimination. You find that for the amount that people earn, for every year of working experience they have, it tends to go up 5% every year, okay? And mysteriously, at the age of 45, it goes flat, right? It goes flat. Why? Right? Because for the people that become directors, yes, they do earn more money, but a lot of people get retrenched and they end up driving Grab, okay? And because of that, your set it generally begins to plateau after the age of 45, right? And of course, we're also part of the sandwich class. For folks by generation, we still have to support our parents and our children. And so there's a lot of balancing act, right? And at the moment that it's difficult to get jobs, right? Yeah, people will feel the economic pain. And in 2020, during the pandemic, right, PAP has actually lost Sengkang as a result of that, right? So the lesson in autumn is you're no longer at your earning peak and you're facing retrenchment in the workplace, right? And of course, many people are upset because you lose your parents at this stage in your life, right? I lost my dad about 5 years ago. So this is actually a very difficult time to go through for actually most Singaporeans, right? It's yeah, your boss don't like you anymore, you're too expensive, and you have multiple priorities at home, right? Okay, so one of the myths in autumn is that investing is a little bit too complicated and they can distract you from the realities of life, right? And the truth is that for dividend counters, a lot of complexities can happen, right? Take for example, the Sabana Industrial REIT. If you invest in this real estate investment trust, you should be enjoying 7% of dividends every year, which will make it an excellent investment because the 7% dividends comes denominated in Singapore dollars, right? But here's the problem, right? Shareholders like me, we basically voted to make way for an internalized manager. And so there is a lot of uncertainty investing in this counter. Dividends have been going down because the trustee has decided to keep 10% of the dividends in case they need to spend for the internalization. Okay. And but for many investors, we are invested because we believe that moving forward, we can have an internal manager, and that would drastically improve the alignment between the manager and the investor. All right. So these things can happen if you own a dividend counter. And therefore, there is a lot of there's a lot of questions about whether I should get a bank, right? Like what will happen to net interest margins, net income margins, NIMs, right? When interest rates were to drop. Okay. So so that's something that would complicate the life of a dividends investor, right? I think that there is a simpler way to make it work. And one thing is that a lot of people do not know whether dividends investing, the FIRE movement, whether is it the right kind of lifestyle for you. And I think that the simplest way is to try this idea out for size, right? The only way for you to find out whether this idea works well for you is to find a way to start with a dividend flow of $100 a month, right? Now, you can find blue chips in Singapore that give about 5% dividends very easily, and you can look at the newspaper tomorrow to confirm that, right? The trick is, if you can set aside $24,000, right, to buy these blue chips, then you'll be able to get $100 of dividends every month, all right? It's 100 multiplied by 12, divided by 5%, divided by 0.05, right? You get $24,000. And this is very important because if you're able to find a disciplined way of getting these $24,000, saving $2,000 every month for a year, or maybe working a little bit of overtime so that you can build up this 24,000 in a faster way. All right, you'll be able to get your first golden goose, and this is very crucial, right? It is a golden goose that lays $100 of passive income using $24,000 that you have, right? And it's achievable by setting aside $2,000 save every month, and it lays $100 of golden eggs every month for you, right? You can use this $100 to get a Netflix subscription, maybe upgrade your Spotify to Spotify Premium, right? Yeah, it's not a lot of money, but I think the most interesting thing that you can do is to get your additional $100 every month to get your next golden goose, right? Your next golden goose will be a lot easier to attain because you've already got one golden goose. And so that's how we do it, right? We get the first golden goose is always the hardest, but the second and third golden goose will become progressively easier because you have already given yourself $100 increment. So that's how you use compound interest to obtain financial independence. And so that's the autumn tip. Get your first golden goose. Now, regardless of whether you want to see whether you know your personality type and your inclination that you can actually achieve financial independence this way, right? A journey of 1,000 miles begins with the first step, your golden goose. All right. So here's the autumn tip that I have for you. All right. Yeah. And so autumn generally is a very tough period in your life. Okay. And I think what we need to do is we should keep ourselves afloat. And before you get fired, before you get retrenched, right? Find a way to make money using your money, right? $100 every month will at least show you that, hey, I'm able to make some money rather than by going to work, right? So I've now found another way of making money, right? So that's a huge morale booster. All right, and so finally we are on to winter, which is the final quarter of your life, and this is where you enjoy the fruits of your labor. You know, your happiness goes up again, right? All right, so this is a travel photo of me, and this is my current life so far. And I don't have like a very glamorous kind of lifestyle to share. I prefer to focus on very simple living, and like my example of financial independence is to be able to have butter kaya toast and butter coffee on a weekday afternoon with no one controlling my time, right? That's why I put the picture here, right? The first benefit that I enjoy is I get to bring my son to school and I bring him back from school every day, right? And in that process, I built a stronger bond with my son that actually I don't have my daughter because when my daughter was going through kindergarten, I was still working at the time, right? Next is my dad. When my dad is on his final stretch in Tan Tock Seng Hospital, I visited him every other day, but the situation did not improve. So these were the final moments I have with my dad, okay? And basically that was it. So for the people that you have a loved one, financial freedom will also give you more time to spend on your parents, for example, right? Very important if you're going through autumn and your parents are also getting old. All right, so generally in winter, what you expect is that your expenses will drop by about 30%, right? And you'll be focusing your expenses on food, your home furnishing, as well as health, right? Health will be a major problem as you get older. We also face a lot of longevity risks. Singaporeans are living up to 85 years old, but we are only healthy up to about 72 years old on average, right? You see a very successful real estate magnate passed away at the age of 71, right? To cancer. Okay, that's actually an outlier. Most Singaporeans do live up to 85. All right. So living too long becomes a possibility and you need to hedge longevity risk. Right. Now, there is also the problem of retirement inadequacy. Okay, now one of the news is obviously the CPF special account has been removed. So you've lost a savings account with a stable 4% return, and I'll teach you how to deal with that later on. Okay, but the news is that if you're 65-year-old today, with a full retirement sum, $200,000, you will only be able to get $1,150 every month from the standard plan, right? And that's the highest payout, the highest possible payout. So the Lee Kuan Yew School says that the 65-year-old needs $1,421. So to attain this basic standard of living is about $1,500. There is about a $400 shortfall. So even if you succeed in getting FRS on your CPF, you still lack $400 every month, right? You still need to find a way to get 4 golden goose running around laying eggs for you to solve the problem of retirement inadequacy, All right, so I'm going to leave you with a problem. I'll try to show you how I solve it later on. Okay, so one of the lessons in winter is what happens at this stage will depend on how well you play the previous stages of your life. And there's actually nothing much you can do once you get into this stage. All right, and the winter myth is, market crashes can destroy your life, right? So a lot of older people listening to me today is that you're concerned that, what if the economy does badly over the next 3 to 4 months and we end up in a crash, right? Okay, so what happened to me was in the Great Recession of 2009, I was working for a Singapore Mercantile Exchange. It's a commodities exchange, and I was able to save my entire paycheck every month, okay, and basically live on my dividend, right? But unfortunately, because of the Great Recession of 2009, I find that my portfolio has shrunk, and it shrinks by more than the amount that I put in. So actually, I become poorer and poorer every month during the Great Recession of 2009. So I was the butt of all jokes. I continued being invested, but I continued to lose money, right? So at one point of time, my colleagues were laughing at me because I lost an entire BMW to the stock market, right? And what I have here is the fact that I know something that my colleagues did not know. And this is a history of market crashes. And I've only taken note of the 30% crashes. So if a crash is 30% or more, I'll create an entry on this chart, right? And as you can see, the longest crash that we've ever had was the Asian currency crisis, all right? Was the Asian currency crisis, okay, that lasted 706 days. Now, why is this important? It means that if you are subject to a market crash, if you continue buying the stock market for 2 years, the markets will eventually recover, right? It will eventually recover from the bottom, which means that all you need to do is to double up, find a way to make more money, and then farm everything back into the financial markets, right? So when I was able to do that at around 2009, the markets began to recover, and I tell my friends the BMW that I've lost came back as a Maserati. All right, so this is how you handle a recession. Okay, so market crashes are your ally in wealth building. The average yield for real estate investment trusts is a double-digit number in the year December 2008. All right, so while real estate investment trusts they are considered relatively cheap, you're getting about 7%. It didn't come close to the kind of bargains I had in the year 2008. Right, so much so that when I bought these real estate investment trusts, Ascott, REIT, Mapletree, and all that, right, it really was able to catapult me into becoming a millionaire a couple of years later, right? So markets are a lot more attractive these days, right? You will find that there are still real estate investment trusts like United Hampshire that give you close to 10% yield, right? ESR 9.5, So there are attractive bargains right now, right? And if you're able to build a dividend portfolio today, combine it with some banks and some business trusts, right? This is how you can use money to make money. Okay, and of course, what this slide basically tries to say is that Singaporean stocks right now, they are twice as cheap as the US equivalent. And in the US, only the AI stocks, the Nvidia and all that, they're doing well. The rest of the counters, they are not doing particularly well, but they are very expensive with a cyclically adjusted price to earnings ratio of about 30, all right? So the tip in winter is market crashes are your ally in building great wealth, all right? Do not be afraid of market crashes. A lot of wealth transfer happens at a time. Make sure that the wealth transfer is in your direction. Okay, so we've basically completed the discussion on the 4 seasons. I'm just going to summarize the 4 truths that I've shared with you today. The first is that your X factor can come from reading popular finance books. That's not true. You need to invest the time to learn finance the hard way, all right? Pick up some solid financial skills. Understand the mental models to become a good investor. Invest your time to learn how to make money with it. Retirement is impossible unless you listen to an advisor. I've shown you how toxic and expensive these products are. In fact, retirement is possible if you're willing to level up your investment knowledge and do a little bit of DIY investing, right? I've shown you how to get double-digit returns even in a difficult market like Singapore. Investment is too complicated. It can distract you from the realities of life. You won't be able to make it. That's what people always try to tell you, right? Why don't you listen to me? You won't be able to make it. The proof is that no, right? The most difficult part is getting your first golden goose, right? Save $24,000 and divide it between all the blue chip counters in Singapore that produce a 5% yield, you will have your first golden goose that generates on average $100 every month. All right. Then you would have taught yourself how to use money to make money. And finally, market crashes can destroy your life, right? Market crashes are, in fact, your ally in building great wealth. Markets are relatively cheap right now. I do not foresee a crash coming to Singapore anytime soon, right? Okay, so what am I really driving at, right? The message I'm really driving at is actually as we go through the four seasons, right? We realize that the Singapore dream is dead, right? You know that traditional advice that's failing us. Go to school to get good grades, and then after that, go to a university to get a good honors degree, preferably a professional degree. Okay, get a good honors degree, and then get a steady job. Make sure that there's financial security. Claw your way up the corporate ladder. Along the way, accumulate your 5 Cs, and then when you retire at the age of 65, you start collecting your CPF life, right? And then your children will then go on and do the same thing, right? That doesn't really work anymore, right? Now, I'm going to propose to you a new kind of Singapore dream where you can take the 5 Cs and you can toss it into the garbage bin, right? I think that you replace 5 Cs with 1D. You replace it with dividends, right? And this is what dividends can do for you, right? In spring, you can support your children's education, let them focus on a paper chase. On summer, ease minor expenses, smooth out lumpy salaries while you settle down on a corporate workforce. In autumn, address sudden expenses related to children's education, parents' medical expenses, cope with retrenchment, change your career. In winter, it can assist you in hedging longevity risk, paying for medical expenses, and preventing yourself from becoming a burden to your children. All right. This is how dividends show up in your bank account, right? It's like a present that you can open. And if you have 60 stocks like me, right, you get a present almost every month, all right? Almost every month, not January, but almost every other month. Okay. Okay, so if you can sustain the dividends in investment strategy over more than a decade, what is likely to happen is that you might be able to get the same kind of dividends I got in the second half of 2020 when the pandemic struck. So when the pandemic struck, the portfolio was still giving out solid dividends, about $13,000 a month or $80,000 for that 6 months. All right, the portfolio size is about $2.4 million, and the yield is approximately 6.6% at the time when the slide was built. Okay, to give you a perspective, the household income was 7,744 then when the slide was made. And if you buy a $2.4 million condo in town, you can rent for about $5,500 to $6,000. All right, so obviously now times have changed, the numbers need to be adjusted a little bit, but this just gives you a perspective of what dividends can do for you if you can sustain the approach over a long period of time. Okay, so we've more or less come to the end of the first part of the workshop, right? In the next part of the workshop, all right, I will talk to you about what the early retirement masterclass is. You take up 20 to 30 minutes of a time before a Q&A, all right? And so now it is 8:38. You've spent some time listening to me. I will come back at 8:43, all right? 5 minutes later, all right? If you have any questions, put them on the chat group and we'll go for round two 5 minutes later. All right, see you later. Okay, welcome back. I'm now going to talk a little bit about the Early Retirement Masterclass, and this is a 5-day course to help you recapture the Singapore dream. Okay, and there are three objectives. The first objective is to assist you in transitioning into an independent and successful DIY investor with support from a community of like-minded friends. All right, so that's the first objective. The second objective is obviously to help you create a secondary source of income that will meet your lifestyle needs. And the third, to gain the ability to use a data-driven framework to grow your portfolio in ever-changing market conditions. All right. Now, what is the outcome that we really want when we sign up for a course like that? Right? You want to build a portfolio of local stocks, about 15 to 20 in number. It should contain a very decent mix of blue chips, real estate investment trust, and business trust, right? It should be designed to provide about 5 to 6% dividend spread across the year and consistent with our view of the current market cycle, right? So how we feel about the markets and all that, it should be consistent. Build the portfolio once, leave it for 1 year, collect the dividends, and then rebalance 1 year later, right? So it's like owning a cactus plant, right? It requires minimum amounts of maintenance, all right? So this is the kind of outcome we want when we come for a course like this, right? And how do we prepare our students? There are 4 days of online training where in the evenings I will conduct training like this, okay? And then after that, on Saturday, we will meet up. I will split the class into different groups, and you will be assigned some amount of work, right? You'll be assigned some stocks for you to investigate. You'll be taught how to investigate, of course. And then at the end of the process, you will then build a portfolio as a class together. All right. So this is how we prepare our students. Okay. And if you look at the kind of slides that I have, don't be intimidated. You will eventually know what all this means. It basically means that this has solid content. All right. This class has solid content, and you'll be learning some solid investment skills. All right. Now, what is special and unique about the program is because I can code. And because I'm able to code, right, I was able to build a web application that would turn my room full of students into a room full of investment analysts, right? I have computer software that would accept your input, and then it would be able to perform some calculations on the portfolio that is built by the class collaboratively, right? Imagine what it's like to have multiple people working on a Google document at the same time. It's that kind of ability to do that, but it is in finance. It performs calculations as you actually approve the stocks into the system, right? We will participate in 2 rounds of portfolio creation. The result will be a REIT and a blue chip portfolio that can be deployed into the financial markets, right? So this is how a sample portfolio looks like from the year 2021. It's a portfolio that generates about 5% dividends. Now my students are producing 7%, right? Because dividend stocks are cheap, okay? And the back-tested annual return for the past 5 years is about 17%, all right? So this is the kind of portfolio that my students build. And notice that most of the time, the portfolio is on the upswing, right? When it's on the upswing, you notice that it's green in color, right? Yeah. So every single investment decision is then contained in a portfolio PDF, right? And generated and given to the class, right? So I think that's important, right? And with this PDF that the class will author together on Saturday, you will then be able to execute your own stock recommendations the following Monday, right? So you do some work, right? It is like problem-based learning, right? You're building a portfolio together. How do you do it? And then at the end of the day, you get the portfolio and you can execute it by DIY investing the following week, right? A 17% back-tested strategy can actually get you to retire within 10 years, right? And without the use of leverage, right? And so this is how such a portfolio can fit into CPF Life, right? So the strength about CPF Life is that when it begins to give you a payout at the age of 65, you get a fixed payout for the rest of your life. You don't have to worry about the payout stopping, right? The only thing you need to worry is inflation, and it cannot fully mitigate the effects of inflation, right? Because even if you pick a inflation fighting CPF Life, it can only increase by 2% every year. So if inflation is 4%, you will still lose money to inflation, right? But this is what a dividends portfolio can do, right? A dividends portfolio can give you 5 to 7% of dividends a year. There is a risk the price of the portfolio can go down. But generally speaking, because you've got a lot of real estate inside this portfolio, it fights inflation better than many other instruments. So imagine if you have $1 million and you've got $300,000 in CPF Life under the standard plan and $700,000 in dividend stocks, right? You're able to get about $4,556 of passive income every month, right? And even if the dividends completely disappear, you still have 1,600 every month from CPF Life, right? So it's a very powerful method to fight inflation, right? So this is a very, very solid kind of retirement plan on $1 million of portfolio size. The relationship with the trainer continues after the course, right? I have an early retirement masterclass Facebook group where we conduct community events once a quarter. You can ask me questions on the Facebook group and I'll generally respond within a day. Okay, and there are like 700 alumni now, right, who can assist you with questions. Okay, and lifetime access to portfolios built by subsequent batches of students will be made available to you. There's no monthly membership and no upsell of advanced courses. So if you come for my class in June, when I conduct another class in September, you will also receive the PDF output from a future batch of students. And this lasts a lifetime. So long as I conduct the course, right, you will be able to benefit from a lifetime of updates. Okay? All right. So final note on conflict of interest. I'm a strong believer in skin in the game. So unlike a lot of other instructors in Singapore, I generally will invest a part of my course fee into the portfolio as part of a class exercise. And the reason why I do this is because the truth about financial markets is that you will occasionally lose money, right? And when you lose money, the instructor should lose money along with you so that the instructor will do his best to make sure that his material, right, will always be in his prime. That means I should always teach material that would try its best to make my students money, all right? And the truth is that most dividend portfolios are currently flat at the moment, okay, but it still generates a decent amount of income for me, all right? So basically, the course fees are still producing dividend income for me today, right? Now, what are the cost prerequisites? All right, generally speaking, if you want to benefit from having an investment program, you should have at least $10,000 to build your first portfolio. And this can either come from CPF or SRS, all right? It's fine, whether it's cash or not, it's fine. If you don't have $10,000, then you should have a decent income. You should be currently employed so that there is a good chance for you to build up a portfolio of $10,000 within the year, right? And so this is the amount that you need to benefit from this class. Now, the course requires some IT and mathematical knowledge. You need to learn to operate a laptop and a mobile phone. The maths is very simple, all right? Lower secondary school maths, all right? So you don't have to worry about the maths being too difficult, right? And we will spend some time to make sure that your foundation is strong. Okay, so here's a case study. My student, Donna Darrington, was a student from batch 9. She made her first dividend in 16 days, and she was in between jobs at the time. So she has some savings. I got her to buy Netlink Trust, and she was able to actually get a payout while she's in between jobs, right? Donna is the lady on the right, not the lady on the left. Okay, if I look at Donna's numbers a year later after she came for the class, she got her first golden goose within a year, all right? So these are the small wins, right? These are the small and humble wins, okay, that show how effective a course is, right? So right now, what you need to do is to ask yourself, what is the value of your personal freedom, right? If the course takes you 20% towards your retirement target of $500,000, then you will be $100,000 richer. At 20% of that, the course is easily worth $20,000, right? And every strategy will be documented and sent to you at the end of the program. The second thing that the course will provide for you is a bespoke printout, okay, of every single portfolio decision being made by the students, right? Whether to put it in or not to put it in, what were their thoughts when they looked at the analyst report, okay, and why is the stock selected into the final portfolio, right? The program would then automatically generate very useful statistics on a portfolio that requires a lot of intensive mathematical calculation. It is also automated for you. In order to do that, you need to have an instructor who can code. And if you want to try it out on your own, you might need a Bloomberg terminal that will cost you tens of thousands of dollars. For the people who are absolute beginners and do not even have a trading account, I've written a manual to guide you on how to open a trading account and to give you a little bit more readings for you to actually get a firm grasp of personal finance, right? The equivalent hand-holding will also cost you thousands of dollars to do that. I have a network of partners and tools that students can sign up to actually gain the capabilities of gain very close capabilities to a fund manager, okay, as well as track their portfolios and their dividends. The combined cost of all these subscription software does not exceed $20 a month, right? It's actually less than that. So very cheap, very effective, okay, and something which I think is compulsory for people who want to take retail investing seriously. And finally, once again, the Early Retirement Facebook group. That's where we gather. That's where I provide updates to everyone. Okay, and that's where you can interact with me. Okay, membership is forever, so long as I continue to run the course. Okay, and uploads the investment decisions of all future batches of students, as well as all the students in the past, right, can be found in this Facebook group. All right, very valuable resource for you to have. Okay, so we are conducting 4 days of online webinar from the 11th to the 14th of June in 2024, right? I will be covering, these are the basics of personal finance, how to understand the economy, how do we perform our investments, right? Then I'll go into the various asset classes, fixed income and business trust investing, blue chip investing, small cap growth investing, REIT investing, leverage, and then I'll talk a little bit about mortgage insurance and government schemes, all right? So all very valuable, okay? But on the 5th day, on a Saturday, 15th of June, right, we will meet face to face where I will facilitate the program to build a portfolio that together, right? And there'll be quizzes and there'll be a lot of reinforcement exercises on that day, all right? Yeah, so it should be quite fun and should be quite interactive and also a fun networking session for you, all right? The total cost of the program is $3,888. Okay, but if you were to respond to Dr. Wells' message that they just put up, if you respond to the link, then we have a special price of $2,568. You can pay by installment, that'll be about $200 a month, right? So if you got enough capital to get 2 golden goose, well, you can offset the installments with the dividends that you get, all right? So the cost can be free, okay? The cost can be free, okay? All right, so imagine folks with capital, right? If you already have $100,000 and you invest in a portfolio built from this class, the dividends alone will be more than $5,000 every year. And we're not even talking capital gains, right? So this is a very attractive program for people who have at least $100,000 to invest. All right, you come for the first day of the course. If you're dissatisfied with what you're learning and know that this course is not for you, you are free to exit and we will refund all your money back. All right, let Dr. Wells know that you want a refund within the first day of the course or the second day of the webinar, and we will carry it out for you. All right, so this minimizes your risk. If you act within the next 72 hours of attending the preview, okay, we will provide a special package for you. You will get all 3 PDFs of the books that are written, as well as beginner readings, right? These are blog articles from the Dr. Wells blog that actually are focused for people who have just started out on their investment journey. And there are also 2 bonus lectures on earning more money and saving more money. Okay, all right, so this slide contains the course timing, 11th to 14th of June, okay, and 15th of June we'll meet face to face, and the price is $2,568. Okay, and that's it. All right, so what I'm going to do now is that I'm going to try to answer the questions that you have. Keep the questions coming, okay, and if there are no questions, I have about 4 to 5 slides that we can conclude this evening's procedures. All right, so let's scroll down to the Q&A. All right, okay. Rachel Tan, will the market crash soon? I don't think the markets will crash. The reason is because our price to earnings ratio is actually relatively low right now. And even if you cyclically adjust it, the price to earnings ratio will remain low. So actually the market will not crash. It is more likely that when interest rates begin to drop, right, you find that the Singapore markets might actually reach an all-time high. That the probability, I think, is a lot higher. But then again, we don't know, right? If Iran were to declare war on Israel, right, maybe things might change for the worse. Okay, yeah. Let's see. Rachel Tan, can you explain how you leverage again? So if the interest rates are high now, then probably will be hard to leverage now, right? Yeah. So I think that's the problem with leverage, right? If interest rates are high, then you find that most of the bonus dividends that you get will be used to pay for the interest rate of the loan that you have, right? And I wouldn't say that the interest rate is high, it is moderate, right? 4.8% for most of the brokers, right? So if your dividend is like 5%, not worth it, right? Because the amount that you get from your dividend is quite low. So I think what you can do is you can wait until beginning of next year when interest rates begin to drop, then you can start engaging in leverage. All right, now might not be the best time to do so. Okay. Don Lam, why do you only invest for dividend and not on global markets or even the US markets? All right. In this program, I do teach an example on US markets, right? We will take everything that we learn and we apply it to the Dow Jones Industrial Average, right? Remember, an investment course should arm you with investment knowledge and is market neutral. You can take the knowledge and apply it to any market that you wish. Okay, it's just that I happen to use examples in Singapore because it's easier to teach the concepts. All right, and I do teach the US markets. All right, so I hope that sort of answers your question. So this is in fact a program on some amount of international investing as well. All right. Okay. I guess that's it for the Q&A. All right. If you have some questions for me and I've not adequately answered them, you can always write to Dr. Wealth staff. I'll get back to you. All right. Okay, so let's finish up. All right. And I think the final question that I hope to leave with you is the question of where the customer's yachts. When you listen to a finance guru and you say, well, the person's a millionaire, but what about his students, right? Yeah, that's an important question because if the trainer is a millionaire and his students are not, right, that means the trainer is making money from his students. Okay, right. Let me just give you an aspirational illustration of my best student, student M. The couple are high-powered finance executives, they're mid-30s. The husband attended the class in 2019. The couple know a lot of finance already, but something clicked when they attended my class, right? They find that I'm able to take everything in the field of finance and sort of monetize it and weaponize it, right, for their use. So the husband and wife fund $30,000 every month to every ERM portfolio built by students from December 2019 to the present day. And the portfolio is a margin account with 2 times the leverage, all right? And then they invested through the 2020 pandemic, all right, through the 2020 pandemic. The internal rate of return of 10 to 11%, because this leverage, they were making 17% a year. And most importantly, in less than 2 years, the portfolio size swelled to about $1 million, right? Half the portfolio is owned by the couple, half of it is obviously owned by the broker. But these are fantastic results given that you've just attended a course and you paid a couple of $1,000 for it. All right. And this remains, I think, the most powerful testimonial to my program. So with that in mind, I hope that you'll be happy to reinvent yourself for this year of the dragon. Give yourself a chance to pick up some skills on early retirement. Let it change your destiny. And I hope that this can be your new Singapore dream. I hope to see you in class in June. Good night and have a good evening. Thank you very much.